There's a moment in every empire's decline when multiple systems fail at the same time, not sequentially, not one after another, allowing for adaptation and response simultaneously. The monetary system, the trade system, the banking system, the alliance system, all showing stress fractures within the same narrow window of time. That moment has arrived. Between January 3rd and January 24th, 2026, we witnessed something that has only occurred 3 times in recorded history: the simultaneous breakdown of confidence in 4 foundational pillars of global economic order. And if you understand what this convergence means, you'll recognize why this isn't just another cycle of market volatility or political tension. This is the mathematical endgame of a system that has exhausted its ability to extend itself through conventional means. On January 3rd, American forces secured $17.3 trillion in Venezuelan oil reserves through military action. 8 days later, a banking executive warned that $6 trillion could flee the U.S. banking system within 36 months. 16 days after that, the largest trade relationship in human history, since $160 billion annually between the United States and Canada, was threatened with complete severance. Simultaneously, institutional money began flowing into alternatives that didn't exist as viable options 5 years ago. BlackRock's Bitcoin ETF reached $70 billion in assets in just 2 years. Stablecoins paying 5% interest while bank deposits pay 0.1%. Federal regulators approving crypto infrastructure at accelerating pace. But these aren't isolated events occurring in different spheres of global finance. They represent pressure points in a single, interconnected system reaching its tolerance limits. The Venezuelan oil operation wasn't conducted in isolation. Intelligence sources suggest it was coordinated with similar resource-focused initiatives across 3 continents. Mining rights in the Democratic Republic of Congo valued at $24 trillion in rare earth minerals. Agricultural land acquisitions in Ukraine totaling 12 million hectares. Deep-sea drilling contracts in the South China Sea covering 200,000 square kilometers. Each appears justified by different rationales: national security, energy independence, food security, strategic competition with China. But when viewed collectively, these represent a systematic shift from purchasing resources through market mechanisms to appropriating them through force or coercion. This transition occurs when conventional financial capacity can no longer support imperial requirements through normal channels. Each event, viewed individually, appears manageable: geopolitical maneuvering, technological disruption, trade negotiations. But when multiple foundational systems show stress simultaneously, when the responses become increasingly desperate rather than strategic, when solutions create larger problems faster than they solve immediate ones, this indicates something fundamental about the system's stability, or lack thereof. In 1780, the Dutch Republic faced 4 simultaneous crises that would end 2 centuries of global dominance within 4 years. Their currency, the guilder, came under pressure as other nations began questioning whether Amsterdam could maintain convertibility. French and German banking houses started demanding gold for guilders rather than accepting paper promises. The Amsterdam Exchange Bank, which had secretly been operating on fractional reserves since 1672, faced the possibility that depositors would discover their gold reserves had been lending to the government for over a century. The pressure wasn't random. Foreign intelligence had learned the truth about Dutch gold reserves through diplomatic channels. French spies had infiltrated the Amsterdam banking community. British agents had documented the discrepancies between official reserves and actual holdings. The information was being weaponized systematically. Their trade empire faced military challenge from Britain, disrupting routes that generated their wealth. The Fourth Anglo-Dutch War wasn't just about territorial disputes. It was economic warfare designed to strangle Dutch commerce. British naval forces attacked Dutch shipping systematically, destroying not just vessels, but the insurance markets and credit relationships that made global trade possible. But the British strategy went deeper. They had spent 5 years building alternative trade routes that bypassed Dutch commercial networks entirely. Direct relationships with Asian spice producers, alternative financing mechanisms through London banks, insurance markets that competed directly with Amsterdam. By the time the war began, Britain had already constructed the infrastructure to replace Dutch trade dominance. Their banking system, the foundation of their power, revealed massive hidden losses from government lending. The Dutch government had borrowed over 200 million guilders from private banks to fund wars and public works. These loans represented 300% of annual tax revenue, sustainable only as long as the economy grew faster than debt accumulation. By 1780, that mathematics had reversed. The banking crisis wasn't isolated to government debt. Private lending had expanded beyond sustainable levels. Speculative ventures in exotic trade, real estate bubbles in Amsterdam and major cities, leveraged investments in colonial plantations. When government finances destabilized, private credit markets froze simultaneously. The entire financial ecosystem collapsed within months. Their alliance structure collapsed as former partners sought protection elsewhere. Prussia, Austria, even small German states that had relied on Dutch financial backing began aligning with Britain or France. Not because they preferred these powers, but because Dutch financial guarantees had become worthless. Each crisis was manageable individually. The Dutch had survived monetary pressure before. They had won trade wars. They had absorbed banking losses. They had rebuilt alliances. But never all four simultaneously. The convergence overwhelmed their capacity to respond. Resources deployed to solve the monetary crisis weakened their military position. Military spending to protect trade routes drained their banking system. Banking system stress destroyed confidence in their currency. Currency instability shattered alliance relationships. By 1784, Dutch global dominance was over, not because any single crisis proved insurmountable, but because multiple crises created cascading failures that amplified each other beyond the system's ability to contain. Britain understood this pattern when they orchestrated the Fourth Anglo-Dutch War. They didn't attack Dutch strengths directly. They created pressure on multiple fronts simultaneously, knowing the Dutch couldn't respond effectively to everything at once. The strategy worked perfectly. We're observing the same pattern now, the same convergence, the same systemic vulnerability, the systemic fracture. The Venezuelan operation represents something unprecedented in post-World War II history. A military operation conducted by the world's dominant economic power to secure resource assets worth $17.3 trillion. This only happens when conventional financial mechanisms can no longer generate required resources through normal channels. When the gap between government spending obligations and government revenue generation becomes so large that external appropriation appears necessary. The United States carries $38.5 trillion in debt. Interest payments alone exceed $1 trillion annually. The deficit runs at $2 trillion per year, with no political mechanism to reduce spending or increase revenue sufficiently to close the gap. Venezuela's oil reserves don't solve this mathematical problem. Even at peak production, Venezuelan oil generates perhaps $50–60 billion annually in government revenue. Against a $2 trillion annual deficit, this is accounting noise. What the operation demonstrates is desperation disguised as strength. Systems that can finance themselves through conventional means don't conduct resource seizure operations. They purchase what they need through normal markets. But the implications extend beyond immediate financial calculations. The operation signals to global markets that the United States considers resource appropriation through military force a legitimate policy tool. This fundamentally alters how other nations evaluate their own resource security. Brazil, which holds the world's second largest oil reserves, has quietly increased military spending by 40% since January. Nigeria has signed defense cooperation agreements with 3 different powers within 2 weeks. Kazakhstan has begun negotiating simultaneous security partnerships with Russia, China, and Turkey. Resource-rich nations understand that if Venezuela can be occupied for its oil, they can be occupied for their resources. This creates incentives for rapid alliance building, military modernization, and strategic resource deployment that destabilizes regional balances across every continent. The banking system fracture reveals a different vulnerability. For 75 years, American banks have operated as the foundation of global finance because they offered the best combination of safety, liquidity, and yield available to institutional money. That competitive advantage is disappearing, not through crisis, through innovation. Stablecoins backed by treasury bills yield 5%. Bank deposits yield 0.1%. The risk profile is identical, both backed by the full faith and credit of the U.S. government. The liquidity is superior. Stablecoins settle instantly, 24/7 globally. Bank deposits settle in business days during business hours. The product comparison isn't even close. Stablecoins are objectively superior for any use case except legacy integration with existing systems. Banks understand this completely. That's why $6 trillion in outflows represents their baseline projection, not their worst-case scenario. They're not fighting technological change. They're managing inevitable obsolescence. But the transition creates systemic vulnerabilities that extend beyond individual bank failures. Commercial banks don't just hold deposits. They create money through fractional reserve lending. When deposits flee to stablecoins, the money creation mechanism breaks down. If $6 trillion leaves the banking system over 36 months, that represents approximately $50 trillion in reduced lending capacity under current fractional reserve requirements. $50 trillion in credit that disappears from the economy, mortgages that can't be written, business loans that can't be extended, consumer credit that can't be issued. This isn't technological disruption. This is monetary system breakdown disguised as financial innovation. The trade war escalation with Canada, threatening $760 billion in annual commerce over agreements supported 8 days earlier, reveals the third systemic failure. Stable trade relationships require predictable policy frameworks. When the world's dominant economic power threatens to destroy its largest trading relationship over positions that changed within a single week, this signals complete breakdown in strategic thinking. This behavior emerges when systems operate with zero margin for error, when every relationship becomes transactional, when alliance management deteriorates into economic extortion because conventional diplomatic and economic tools have lost effectiveness, Canada isn't an adversary. Canada is America's closest ally, sharing the longest undefended border in the world. Threatening Canada with 100% tariffs is strategic self-destruction disguised as negotiating leverage, but the threat reveals deeper desperation. Trade deficits with Canada have averaged $60 billion annually for the past decade. In the context of a $2 trillion federal deficit, this represents less than 3% of the fiscal gap. Destroying the relationship doesn't solve the underlying problem. It creates larger problems while generating marginal short-term revenue. Yet the threat was made publicly, irrevocably, without apparent consideration of consequences. This suggests decision-making processes that prioritize immediate political gains over long-term strategic stability. The fourth fracture, institutional capital flight from traditional assets into alternatives, represents the market's loss of confidence in conventional value storage mechanisms. When pension funds and endowments start allocating to Bitcoin, when sovereign wealth funds purchase gold at record levels, when central banks diversify away from dollar reserves, this indicates systematic recognition that traditional stores of value may not preserve purchasing power through the coming transition. The asset rotation isn't random. Institutional investors have access to economic modeling and risk analysis that retail investors don't. When they simultaneously reduce exposure to traditional assets and increase allocation to alternatives, they're positioning for scenarios their models suggest are increasingly probable. Currency devaluation, banking system instability, trade relationship breakdown, social instability, political extremism, armed conflict. These aren't predictions. These are mathematical outcomes of current trajectories that institutional capital is hedging against systematically. Escalation. Through context, these fractures are occurring against mathematical realities that make them particularly dangerous. U.S. debt to GDP has reached 124%. For historical context, Britain lost reserve currency status when their debt to GDP hit 130%. The Roman Empire entered terminal decline when debt service consumed more than 40% of tax revenue. The United States currently devotes 26% of tax revenue to interest payments, and that percentage is rising exponentially. The Federal Reserve faces fiscal dominance, the point where debt levels become so large they control monetary policy rather than economic conditions. Raise rates to fight inflation, and debt service becomes impossible. Lower rates to service debt, and currency purchasing power erodes. There is no mathematical solution that preserves both fiscal stability and monetary credibility. Foreign central banks recognize this trap completely. China has reduced treasury holdings from over $1 trillion to under $800 billion. Japan is selling despite being America's largest foreign creditor. Saudi Arabia accepts yuan for oil transactions. Over 40 countries test payment systems that bypass the dollar entirely. This isn't random diversification. This is systematic preparation for post-dollar monetary arrangements. Energy dependency creates another pressure point that amplifies every other stress factor. The United States imports 60% of its crude oil from Canada, 4.3 million barrels daily. Threatening this relationship with 100% tariffs means either accepting massive price increases that drive inflation, or finding alternative suppliers that don't exist at the required scale. Russian oil is sanctioned, Iranian oil is sanctioned, Venezuelan oil is now under direct American control, but requires $180 billion in infrastructure investment over 15 years to reach meaningful production levels. Middle Eastern suppliers have existing commitments to Asian markets and limited spare capacity. The mathematics are unforgiving. America consumes 20 million barrels of oil daily. Domestic production covers about 12 million barrels. The 8 million barrel gap must be imported. Canada provides 4.3 million barrels. Mexico provides 0.6 million. The remaining 3.1 million comes from various sources globally. If Canadian oil becomes unaffordable through tariffs, that 4.3 million barrel shortfall must be replaced immediately. There is no spare capacity in global oil markets to cover this volume. Prices would spike beyond sustainable levels within weeks. When energy costs rise structurally, everything else becomes more expensive. Food production, manufacturing, transportation, heating, cooling, all depend on energy inputs. Higher energy costs mean lower living standards, which creates social pressure that demands political responses that usually involve more spending and more debt. The demographic tsunami compounds these pressures. Social Security, Medicare, pension obligations across federal, state, and local governments represent unfunded liabilities exceeding $200 trillion in present value terms. Every year, more people retire and fewer workers support each retiree. This is not a temporary adjustment. It's a 30-year demographic reality that no policy can reverse quickly. In 1960, there were 5.1 workers for every Social Security beneficiary. Today, there are 2.8 workers per beneficiary. By 2035, there will be 2.3 workers per beneficiary. The mathematics are inexorable. Either benefits must be cut dramatically, taxes must be raised dramatically, or the currency must be debased dramatically. Political systems cannot implement benefit cuts or tax increases at the scale required. Currency debasement becomes the only politically feasible option. Supply chains remain fragile. Supply chains that took decades to build and require multiple countries cooperating smoothly. When trade relationships deteriorate into economic warfare, supply chains break. When supply chains break, inflation accelerates. When inflation accelerates, social stability deteriorates. The semiconductor industry illustrates this vulnerability. Chip design happens primarily in the United States. Advanced chip manufacturing occurs primarily in Taiwan. Raw materials come from over 20 countries. Assembly happens across Southeast Asia. If any single relationship breaks, the entire global electronics industry faces shortages. Similar dependencies exist across every critical industry. Pharmaceutical manufacturing, automotive production, agricultural machinery, renewable energy infrastructure. Modern economic complexity requires international cooperation. Economic warfare destroys the cooperation that modern complexity depends on. Meanwhile, the wealth gap widens to levels not seen since 1929. Asset prices detach from underlying economic fundamentals because capital flees currency debasement. Those with assets benefit from monetary expansion. Those with wages and savings suffer purchasing power erosion. Social cohesion fractures when the economic system stops rewarding productive work and starts rewarding capital ownership. Political extremism rises when conventional solutions fail to address mathematical realities. The top 1% of Americans now control 32% of total wealth. The bottom 50% control 2% of total wealth. This concentration has accelerated dramatically since 2008, when monetary expansion began systematically inflating asset prices while wages stagnated. When economic systems no longer reward productive contribution, when financial engineering becomes more profitable than actual production, when inheritance matters more than innovation, social contracts break down. People lose faith in institutions, democracy becomes unstable, political solutions become increasingly radical. Every pressure point mentioned reinforces every other pressure point. Debt levels require monetary expansion. Monetary expansion drives asset bubbles. Asset bubbles increase inequality. Inequality creates political instability. Political instability destroys international relationships. Destroyed relationships require military solutions. Military solutions increase debt levels. The cycle accelerates beyond the system's capacity to manage any single element effectively. Historical warning. The Roman Empire appeared eternal until monetary debasement destroyed confidence in imperial currency. The Dutch Republic seemed invincible until multiple simultaneous crises overwhelmed their response capabilities. The British Empire controlled a quarter of Earth's surface until debt levels made their global position unsustainable. Spain dominated global trade for 2 centuries, before silver inflation from the New World destroyed their monetary system, and debt levels exceeded their capacity to service them. France maintained European primacy until assignat printing during the Revolution obliterated confidence in their currency and triggered hyperinflation. Each of these empires faced the same mathematical inevitabilities we observe today. Each believed their advantages were permanent and their problems were temporary. Each assumed they could manage individual crises through conventional tools. Each discovered that multiple simultaneous stresses create cascading failures beyond any system's control capacity. The Weimar Republic provides perhaps the most relevant example. Germany in 1919 faced war reparations that exceeded their economic capacity to pay. Rather than default immediately, they chose monetary expansion. Print marks to purchase foreign currency to pay reparations denominated in gold. Initially, this appeared manageable. Inflation rose gradually. Industrial production continued. Employment remained stable. International observers praised German ingenuity in managing an impossible situation. But the mathematics were inexorable. Each payment required more mark printing. More printing destroyed mark purchasing power. Destroyed purchasing power required even more printing for the same real payment. The cycle accelerated exponentially. By 1923, a loaf of bread cost 200 billion marks. Workers were paid twice daily because morning wages became worthless by afternoon. People used wheelbarrows to carry cash for basic purchases. The middle class was completely destroyed. Savings became worthless overnight. Social order collapsed. The political consequences followed inevitably. Democratic governance became impossible when currency had no value. Extremist movements gained support by promising simple solutions to impossible problems. The Nazi Party rose directly from the chaos created by monetary collapse. Germany's hyperinflation wasn't caused by lack of intelligence or economic sophistication. It was caused by mathematical inevitabilities that political systems couldn't address through conventional means. When debt obligations exceed economic capacity to service them, when international pressures prevent default, when political systems cannot implement required adjustments, currency debasement becomes the only remaining option. The United States faces identical mathematical pressures. Debt obligations that exceed economic capacity to service them, international dependencies that prevent default, political systems that cannot implement required adjustments. The pattern repeats because underlying mathematics never change. When debt grows faster than the economy's capacity to service it, When military commitments exceed resource generation, when monetary expansion becomes necessary to maintain political stability, when alliance relationships deteriorate into extraction mechanisms, these conditions create mathematical inevitabilities. None of these transitions happened overnight. They unraveled gradually through cascading failures that appeared manageable individually but proved overwhelming collectively. Each empire's leadership believed their situation was unique. Each convinced themselves their advantages were permanent. Each assumed their problems were temporary and solvable through conventional means. Each was wrong. The timing varies, the specific mechanisms differ, the participants change, the outcome remains constant. What we observe now, military resource appropriation, banking system disruption, trade relationship destruction, monetary system stress, these are not separate challenges requiring separate solutions. These are symptoms of a system approaching its mathematical limits. The convergence has begun, multiple foundational systems showing stress simultaneously, response mechanisms creating larger problems than they solve. Leadership choosing short-term expedience over long-term stability. History teaches us what comes next. The silence that follows when central banks stop discussing temporary measures, when finance ministers avoid sustainability questions, when institutional money begins moving without explanation. That silence isn't uncertainty. That silence is recognition. The system understands what comes next, even when the public doesn't. Even when the public prefers not to learn, the pattern is absolute. The convergence is underway. The mathematics are inexorable. And this time, there is no external empire to absorb the collapse.